Should we be worried about what's happening in the repo market and the action that the Fed had to take yesterday and again today?
I'm not worried about it at this point, but I think it's something you have to continue to monitor. I think as far as the Fed today, I think what the market is watching mostly is for a hawkish cut, which would imply another 25 basis point cut later today, but then maybe signs that they're not going to do further cuts. So I think for me, that's the primary thing I'm watching for today.
Okay, so you're not concerned about the action in the repo market,
not
even
currently.
though we have to. Okay, well, what would make you concerned when you say not currently?
It's just something I'm going to have to continue to monitor. At this point, I'm not sure it's more than just technical measures that they're doing.
Okay, so obviously the Fed has a dual mandate, and we focus a lot on unemployment. Not as much recently on inflation, just because we haven't seen a lot of moves for a prolonged period of time, although more recently we have seen inflation start to tick up. What are you watching here, and what should we be paying attention to for how that may influence Fed policy?
I think it's absolutely an important point that you're making, because we saw core U.S. inflation actually rise by 0.3% in August. That's the third consecutive month of similar gains. So that would mean that core inflation would move to about 2% year on year by using the Fed's preferred measure, which is the Personal Consumption Expenditure Index. That would put inflation right about where the Fed wants it. If you remember back, Fed Chair Powell had said that he thought the downtick in inflation was transitory and that it eventually moved back to where it was. And at the time, markets questioned him, but it looks like he might have been right. So it actually looks like inflation may move closer to 2% by year end. If that's the case and growth starts to stabilize around 2% as well, then maybe we don't get any more Fed rate cuts this year or next year.
Is that tick up in inflation that we've seen a result of tariffs and higher prices that the consumer is paying?
No, I actually think it's mostly related to the cost of health insurance. And then we're also seeing, we'll probably also see an uptick in oil prices, right?
So today, we largely expect that the Fed will institute a 25 basis point rate cut. The commentary, though, always very important. Some Fed watchers are saying, look, Jerome Powell is not going to really show us his cards this time because the future right now is a little hard to predict. What are you expecting that he's going to signal about future rate cuts or lack thereof?
I think the most obvious thing to watch for is that in the past he made comments that this is a mid-cycle adjustment, and that kind of disappointed markets because they thought maybe this is a one and done or a two and done. I think he'll probably remove that commentary, simply to just kind of take that off the table and correct for an error that they made in the past.
Very interesting. So for investors today, if these are the expectations, how should you be positioned in the markets?
Listen, I think investors are generally a bit more optimistic over the last few weeks, possibly even a month. You have the prospect for fiscal policy coming out of Germany for the first time, which is a pretty big deal if that does happen. You also have U.S. and China trade tensions kind of easing a bit, which is obviously welcome news for the markets. And you also have economic data kind of picking up a little bit in the U.S., which I think was somewhat unexpected. So that's making us a little bit more optimistic, but it's also kind of hard to get too bullish in this kind of environment. And the reason I say that is if you look at North American shipping activity, which kind of tracks the overall economy, it's actually slowed pretty significantly since 2018. And you're kind of looking like we're back in this environment that we were in late 2015 and early 2016 when we were also worried about global recession, right? So we had U.S. growth of around 1.5% to 2%, which is kind of looking like where we're going. But at the same time, we have markets either at or near record highs. So it's hard to get kind of bullish when you have the same type of environment where growth is still slowing.